In this past week, there have been so many different events occurring in the stock market. A couple of them I want to touch on in this video. The first being Oscar Health. Because to start the week, Oscar Health stock plummeted by around 13%. However, in the back half of the week, we have seen a nice recovery up around 12.5%. So we'll discuss what caused this move, but I also want to go over some massive news today between Nvidia and Intel. Nvidia has decided to invest into Intel, and this could make a lot of strategic sense for both of these companies. But let's start by going over Oscar Health. Like I said, it's made a massive move down and recovered very nicely. But over the last year, this stock has been a winner. It's up by 41%. It's a little bit off of its 52-week highs of around $21 per share. When it comes to Oscar's stock price this past week, there have been two main dips. The first occurred on the 15th, and this had to do with the fact that the company announced that they would be launching some convertible notes. These convertible notes are ultimately able to be converted into shares, and what that does to existing shareholders is it dilutes their ownership of the company. And this is a bad thing because overall, what it means is you have less share of the company's earnings. But that is a very surface level of looking at this convertible note. What they are trying to do is raise $350 million to be used for strategic initiatives focused on AI, lowering costs of care, as well as enhancing consumer healthcare experiences. We'll get into what exactly that means here in a second, but the stock fell again on the 16th, and this is because the company changed their plan. What they plan to do on the 16th is instead of raising $350 million, they upsized that to $355 million of convertible notes. So what all does this mean for Oscar investors? Well, let's keep in mind what the whole point of the stock market is to begin with. The stock market was founded for the reason of allowing customers access to capital to allow them to grow their business. Some companies use investments like this to keep the business running. If the business is in bad shape and they are trying to just keep the business running, keep the lights on, keep the equipment running, whatever it may be, then they may look for this type of investment. However, I don't get the feeling that that is the case for Oscar. They are trying to fuel growth. They even mention this in this notice. They are trying to find these growth opportunities and keep cash on hand so that they can continue growing their member base as well as growing the services that they provide their customers. And growth is the right reason to get this type of investment. Yes, it will dilute shareholders. However, at the end of the day, if this fuels growth, that will be an overall positive to all shareholders. And that's ultimately what we want to see. We want to see the stock continue to grow and the company continue to grow. And the best way to do that is by investing back into the business. And one other thing to note with this is the shares are convertible at a price of $24.82. That is well above the current stock price. So these investors, to actually get these shares, will have to pay a premium compared to the rest of the market. And in my opinion, Oscar Health issuing this convertible note is 100% the right thing for the company to do, because what they're going to do with this additional cash is focus on member growth. What we have seen in 2025 is additional members have hurt the company's bottom line. This has to do with additional utilization that causes a higher medical loss ratio. Ultimately, in 2026, when we see this issue resolved, we should see a massive increase in the earnings for this company. And this change in positioning for the company will come at a massive surprise for analysts, because in 2026, the average EPS estimate for Oscar is negative 32 cents. We could see that in 2025, they're expected to lose $1.38. That is probably fair. The company is in a rough spot right now, But if we look back to 2024, they put up 10 cents of EPS. If the company increases their premiums in 2026 like they are set to do, we should see them outperform their 2024 numbers. I think the company should put up anywhere between 20 to maybe even 50 cents of positive EPS. And revenue estimates for the company in 2026 are laughable because right now analysts are expecting revenue to decrease by 6%. This makes absolutely no sense. If premiums go up and member count goes up, we should see an increase in revenue in 2026, not a 6% drop. And in 2025, if they are able to grow their revenue by 31%, I do not see why in 2026 we could not see a 15, 20, maybe even a 30 or 35% increase in revenue. So I am definitely very bullish on Oscar Health for the next couple of years. One company that I haven't been as bullish on is Intel. And today the company moved up by almost 25%. We can see that the stock prior to today was trading around $25 per share and then spiked up at one point to $32 per share over the course of a single trading day. And it's crazy to see, but Intel is now up by almost 50% over the course of the last year. However, if we zoom out to 5 years, the stock is still down around 40%. And this massive 20+% move up from Intel came after it was announced that Nvidia has invested $5 billion into the company. As part of this deal, Nvidia and Intel plan to co-develop data center and PC chips. This will be a great partnership for both of these companies for a number of different reasons. I think Intel is probably the biggest beneficiary. However, Nvidia does gain access to Intel's CPU market, which has been a big driver for Intel. And I've always made the comments that Nvidia is very concentrated in the data center market. What they have needed to do over the last few years is diversify their business and gain some access to these other chip markets. Intel has been the #1 player in CPUs, and this will help Nvidia branch out into that market more. One major difference between this and the Oscar Health investment is that Nvidia actually bought these shares at a discount compared to the rest of the market. They bought their shares at around $23.28, while the market right now again is trading at $30 per share. So if you are buying now, you are getting a worse deal than Nvidia. The other side of this deal is it does more strategically align Nvidia with US government interests. We have seen the government invest around $8.9 billion into Intel over the last couple of months. And that has been major news. And what Nvidia is likely doing is trying to get more in with the government to gain some access to these different markets. They don't want to be left behind because right now we are seeing AMD come out and really start going after the data center market. And Intel has the backing of the US government and has more control over the CPU market. So Nvidia is seeing this kind of middle ground that they're stuck in, and they want to make sure that they have some sort of allegiance with either of these two sides. And it makes a lot more sense for them to align with Intel and gain access to CPUs and a little bit of the government as well. One other thing that I tweeted about today when I first saw this announcement was the fact that this could be a strategic partnership for a number of different reasons. Because right now, the chip industry as a whole has been very reliant on TSM. However, Intel has tried to break into that market with their foundry business. And if Nvidia long-term looks to vertically integrate their business, there could be the potential that they might try to purchase the foundry business from Intel. And Intel has already talked about trying to spin off that side of their business. So this could be a strategic partnership for the long term to gain access to chip manufacturing. That may be a little bit of a stretch, but I do think that long term, vertically integrating your business, like we see with Amazon as well as a lot of other companies, is an important step for gaining a stronger moat around your company as a whole. And that could be exactly what NVIDIA is trying to do over the long term. I personally don't own either of those companies, Nvidia or Intel. I do hold shares of Oscar. This is the YouTube portfolio, and right now we're sitting at an all-time high of almost $81,000. And within the portfolio, we hold Oscar Health as our seventh largest position. We have 225 shares. The market value is around $4,300, and we have a cost basis of around $3,100. That puts us up about 37%. And I've bet big on healthcare in this portfolio. I think in 2026, that industry as a whole is going to do very well and is going to see a very nice turnaround. I've done that as well by investing into United Health Group. I have 24 shares and we're up about 15.5%. But as always, let me know your thoughts down in the comments section. I'd love to hear what's your price target for Oscar in 2026. Also, what are your thoughts on this Intel and Nvidia deal? Do you think Nvidia is going to look to vertically integrate their business by getting into chip manufacturing, or do you think that that is a little bit of a stretch? Let me know down below, and while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.